Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you great guests and great topics that fit into our theme for investing. So today we have one of those, and today with us is Eddie Speed. Eddie, welcome to the show.
How are you?
I'm great. How about you?
I'm doing great.
Okay, wonderful. So before we dive into our main topic for today, I would like to ask you, Eddie, tell the audience a little bit in a kind of summary, your origin story. How did Eddie get to where he is right now? Kind of how did you do that?
Well, I started the note business in 1980, and it was an accidental thing. My father-in-law was one of the pioneers of buying seller finance notes, and he wasn't my father-in-law at the time, but I met him, and he introduced this idea to me, and it was a very good time for seller financing because there was really high interest rates and high inflation.
Okay.
Right. So that type of business does really well when there's a disruptive market. And so that's how I got started. I had no real estate background whatsoever. I was 20 years old.
Right.
So that's how I got started. And my wife and I married in 1982. We moved here to Dallas-Fort Worth. And, then by the 1990s, my specialization was I helped real estate investors learn how to be the bank. And then I would buy part of their notes. I originally set up the note system from the beginning of home investors. And, so I had real estate investors and land developers and stuff. And essentially a big part of my life has been helping people manufacture good notes so that they can sell them in the marketplace.
Okay, that's awesome. And like you said, and it's on your website too, you have done it for a long time. Can we start maybe with discussing real quick for anybody who is completely uninitiated, what is a note and what is a good note?
Okay, so a note is where you're carrying a first mortgage on somebody's property that you sold. You own the property. Now you've owner financed it. You've been the bank. And you're carrying a mortgage and they're paying you every month. And that loan is saleable in the marketplace. It's an asset. So you can turn around and you could sell a house for $250,000 and get $50,000 down. And you could carry $200,000 over a period of time with interest. And you could take that $200,000 note and go in the marketplace and sell it. I bought 50,000 notes like that.
And when you say if we take this to our typical investor who would go out into the marketplace, let's just stick with what you started as an example, a $250,000 house somewhere, let's say in Ohio. And normally they would, like you said, put $50,000 down and get a loan for like FHA or some bank loan. When you say you carry a note, can you describe a little bit how that actually works?
So you say, I'm the seller of the property, but I'm also going to be your bank. Okay. And so you're both, and you sell the property and then you create the note, and then you become the lender. So you essentially are the bank. You have a mortgage on their house. You don't own the property anymore. You have a mortgage on their house. And then all of a sudden you go into the secondary market. Maybe it's kind of prearranged because I've already helped you with the idea of doing this before you ever sold it, right? And then you sell that property, you carry the paper, and now all of a sudden you say, okay, Eddie, I want to sell that loan, right? I want to sell those payments. Payments are $2,000 a year or a month, right? I want to sell those $2,000 payments. And there's various things you can do. You can sell the entire note. You could sell part of the payment every month. You could sell 60% of the payment and keep 40% of the payment. Or you could sell 100% of the payment for 10 years and then keep it for the rest of the note. So there's various ways to do it that people would never have thought about. So I'm a specialist. I bought 50,000 seller finance notes, but I understand how mortgage banking works. I basically help somebody that is owner finance to property or seller finance to property. I help them with strategies that they wouldn't have considered or thought about because they didn't know how mortgage banking worked. And all of a sudden now they have more flexibility than they thought they could have.
Yeah, that's very interesting and intriguing. Now, for the audience that is a little bit more familiar with the traditional system, let's put it, one thing that oftentimes my mentoring clients come to me when we basically through the process of identifying the property and we looking for lending and we have everything basically ready. And let's just for a moment say, okay, they got a traditional mortgage, regardless whether it's FHA or DSCR or whatever, they have a mortgage. And within about, I would say, it used to be about 6 to 9 weeks after they closed, they get a notification that that mortgage has been sold to somebody who is now going to what they call service it. Would you say there is a similarity to what you just described?
It's the exact same transaction.
Okay, great. I asked it that way because most of us, myself included, have seen that happening, right? We have properties and
loans are bought and sold in the secondary market. And that's exactly what I do.
cool.
I'm
Okay.
just a specialist in the type of loans we target.
Right. And so what you suggested we should talk about, and I'm super excited to talk about this a little more, is our investors, meaning like our mentoring clients and myself included, we have multiple properties, almost everybody that is in our system.
Yep.
Got financed at some point in the last 6, 7, 8 years, in all the what I would call traditional, even though we not always call them traditional, they can be DSCR, they can be non-recourse, they can be FHA, they can be bank, they can be whatever. But I would still bucket them all as kind of like a traditional mortgage. So if we have that situation, somebody like going back to your example, I bought a house, $250,000. I have regular mortgage for 200,000. Let's just pretend we haven't reduced the balance. And somebody like that came to you, Eddie, and say, is there a way that we can do something cool? Eddie, you have so much experience, you understand this. Is there something we can do? What could we do? What would you suggest?
So helping people owner finance today, I would say a giant end of that, how we serve people in that area are people with rentals, right?
Which is exactly
Listen,
what they are.
yes, sir.
Yeah.
Every dog has his day, right? It's called market timing,
Right.
right? And
Yeah.
what I found out about market timing, you can't fight it. You can't fight what the market is. It's like fighting the ocean,
Right.
right? Right now, rental properties have a problem. And that is the rent house that used to make an 8 cap is now making a 4 cap.
Yeah.
Right?
Yes.
So it's the same house. It just went up in value, but you didn't get paid for it. Here's what you're really trying to do. You're trying to figure out how to eat an equity sandwich.
Okay.
It went up in value, but you're not getting paid for it. If you made a new investment, would you be okay with it making a 4 cap?
Most people wouldn't. And that's just for everybody listening to us. Why is that? Because we went from like 4% financing, 4.5%, 5% financing to 7, 8, 9% and more.
Well, no, here's the real problem. The real problem in the income, I'm comparing it if you just paid cash, forget financing. Everybody blames financing on the problem. That's not the problem. The problem is increase in rents and increase in expenses. Your house doubled in value, but your rents didn't double.
Right.
It went up. Rents went up and averaged, settled in now at about 20%. Okay,
What,
it's not
Eddie, real quick,
100%
what time period are you looking at?
since the virus.
Oh, okay, cool. So basically
Okay.
last 5 years, something
But
like
here's
that.
the problem. At the same time your rents went up, your expenses went way up,
Right.
right? Your expenses, your rents did not pace with expenses.
Especially with property tax, right? If you think about that.
All of it. Maintenance, tenant moves out, the air conditioner goes bad, in taxes and insurance, and it's this and it's that. And how I know this math so well is I'm involved in several high volume real estate masterminds, Collective Genius, I'm in Boardroom, I'm Investor Fuel. I deal with the fractional CFOs that do the math for hundreds of real estate investors that own rental portfolios. They're the ones that give me the math.
Right.
Like I'm not just some guru out there making up numbers. I'm following the numbers they've given me. And basically, I know the math. Right now, you're earning a 4 cap where you used to earn an 8 cap on the same property.
Correct.
Right?
Yes.
So let me ask you a question. Why don't you consider switching what you do with the property?
Well, I guess the answer, if you really mean that as an honest question, is because I don't know any better.
That's the answer. That is the real answer.
Yeah.
Because when I can show people how to seller finance an identical house they're making a 4 cap on, and now they can make a 10 cap or a 12 cap on the same property, they're like, oh my God, I
Right.
had no idea. And the reason is I'm going to say this, okay? There's 4.5 decades in this business. One thing I've noticed is that real estate investors, if they get to a certain point, they believe in a certain idea, it's very hard for them to rechange how they think. And we were programmed that rental properties was the way to gain wealth. We were essentially programmed. Flipping houses is not wealth. We all know that, right? Owning properties is how you gain wealth. And from 2012 to 2024, 23, that was a truth.
Yeah.
You kind of couldn't mess up. Just stay, stay. And that was because houses were so cheap that you were buying them at a mathematical number. You could surely make money. And then you ride both things. You ride the cash flow, the cap rate, right? And you also rode the appreciation.
Right.
2023 comes along. All of a sudden, your expenses are way more than your rent increases. Now you're making less profit than you were making on the same house in 2019. You're not getting more money because of inflation. You're getting less money because of inflation. Right? And now, 2 years later, people are like, that's a truth to them. It's not like I'm just some guy that pulls out the calculator and shows you some math and you're like, oh, that's interesting. I never thought about it looking at it like that. Now, 2 years later, you're like, are the rents likely to go up in the next 2 or 3 years? Probably not. In fact,
Well, I would say they would go up, but not as much as they need
no,
to.
they're not going up. They're declining. Rents are declining. It's statistically, that's a truth. That may not be in a micro market, but overall, we've hit a cap on what you can charge in rents. And so the market is going in a different direction. That's just mathematically, if you look at, from data sources across the country. Here's what's not likely to go down: expenses.
Right.
What are property values? Once again, if you read something like Citizens Advisory or something like the hedge fund level guys read, residential properties are not, or they're not calling for a big lift.
Well, I mean, that's a different discussion. I'm still very much on the side of looking
I know,
at the
but people
number.
that make billion-dollar bets aren't agreeing with you.
Well, that might be the case. What I'm looking at is the gap in inventory has not been closed, not at all. And as long as that's the case, especially if there's ever an adjustment in the rates that normal people can get to, there will be a lot of people who are interested in properties. Hey, let's take a quick break for a message from our sponsors. If you're serious about growing your wealth, you know the best opportunities aren't always the most obvious. That's why we've partnered with Bob Benodas of Franchise with Bob. He specializes in helping investors like you leverage franchising an overlooked but highly profitable way to create semi-passive income. And for a limited time, Bob is giving our listeners access to his course on franchise investing for free. Inside, you'll learn how to evaluate franchises, minimize risk, and maximize your returns. This course is normally sold for $499, so don't miss out and claim your free course now at edu.franchisewithbob.com/ideal.
Well, let me ask you this. Why on a nationwide basis are our year-over-year listings up 20%? If we still have such a shortage of listings, we're not selling the listings that we've got.
I'm not talking about the shortage of listings. I have an answer.
No, it's not a shortage of listings, it's an oversupply.
Yeah, well, I think what's happening there, to answer that question, and I don't want to argue or say anybody's right or wrong, I'm just giving my own opinion. I believe what has happened is a couple of things combined, but fundamentally, people's circumstances, just as an individual or as a family, changed and they have always changed and they're still changing. And I think people, not in huge numbers, but in a measurable amount, there's enough people that have gotten to the point to say, I can't wait any longer to put my house on the market, even though I know that it's not the best time, or even though I know that if I whatever get after that, the next place will be probably much more expensive than my current place. I think that is a number of people, especially this year. I would say there were many people who were waiting all the way through 24, thinking, okay, when we get a new government and change and this and that, interest rates will come down, and they haven't. You could even argue they have gone the other way. So I think that's part of it. But what I was getting at, like I said, no argument, just my opinion, is the amount of housing that we would need to just cope with the growth in population that we have. Even if you say, okay, we send all the illegal immigrants home, I don't think that gap has been closed. And that's why I'm saying we are in this kind of stagnant situation. I don't foresee much increase in value, but I also don't really foresee much decrease in value.
So let's just say that we can agree about the volume of sales. We can talk about home builder inventory being scary high. We can talk about things that says the market is not absorbing properties at the rate that it was, right? But here's what's the real truth. The real truth is there's people with rental portfolios that have this $250,000 house, and their net operating income before debt service, their net operating income is $10,000 on that house a year. That's a 4 cap.
Yeah, no, I'm totally with you, and right. No argument there.
And here's the thing about it: you can owner finance that same house, and $50,000 down. Let's just say you don't get $50,000 down. That's too much. Let's just agree that that would be too rare. But you could get $35,000 down, right? Statistically, that is a proven fact.
Yeah, right.
Okay. Now you're financing $215,000, and you could carry it at a non-QM rate, carry it about 9.5% or 10% interest. Okay. Your monthly payment's $2,000.
Right.
Now on a rental, you might be renting it for $1,800. Right. But half of the money goes out the door in expenses. So you're netting $900 versus the other model of you're getting $35,000 down. You take that money off the table and you're getting $2,000 in income per month. And so people are going like, wow, you mean that I just take, if you consider that taking the money off the table you've already taken, I'm at 2.5 times the cash flow,
right,
on the same property. And so you just took a rental and found a better use for it. And believe me, I'm pretty good at this math. I do it a lot, right? I use real numbers and a real calculator. Like, it's not hocus pocus math.
No,
If
I
you
totally
get
believe
paid
that.
now
That's true.
versus later, that value of that money now is 100 cents on the dollar. The value of waiting for the money is not 100 cents on the dollar because it's a future value, not a present value, correct?
Right, right.
And so for those reasons, we've got people that have rentals that go like, you know what? I never thought about looking at it that way. And I'm just simply saying there are times that it's more profitable to be the bank than a landlord. And there's more times it's more profitable to be a landlord than the bank. And I believe that we are on the banking advantage side it's the cycle that we're in.
Yeah, I agree with that. Absolutely. I mean, the other thing that you said, I think is very important for the audience to also realize, and I have examples like that where I bought a house like 6 years ago in the Midwest for, let's say, 110,000. And without even going to do an appraisal or stuff, I can, let's say we believe for a moment what Zillow's estimate says, and it says 150, just for the sake of argument. So those 40,000, that equity that you mentioned in the beginning, is just sitting there. I can't really do anything with it, right? But in the context of, okay, I paid what, basically 20 or 23, 25, whatever, something like that. And the rest is finance. Here we are 6 years later. So there's maybe 75,000 left on the balance. So literally it's at 50% or roundabout. Right. So that's also something to realize. I think that you pointing out, rightfully so, that you're really only getting part of the value that has accumulated because it's just stuck in the property, basically.
So I that's how I help manufacture notes, right? And I help people, real estate investors, I help realtors. You know, a realtor never thought about it, but there's a whole client base out there that no realtor's even thinking about unless they're
Of
taught.
them actually don't really, in my opinion, in my experience, don't they always say we're also working with investors, but rarely really do it in any kind of level of depth. And I think what you're pointing out is those are us, you and me and other people like us are pretty much the only game in town anyway right now.
Yeah,
Right.
so realtors have a shot to increase their listings because they're showing a landlord how to reinvent themselves from going from having a rental to now having a mortgage, a first mortgage on the same property, right? Now, why does that matter to me? That matters to me because I'm a note buyer and I help people with strategies where they can go sell all or part of their note, enough money to pay off their underlying and to go take some capital and go do some other things with it, but they can still keep an income piece on that note on a long-term basis, right? And so then I teach people in note school how to buy notes. Because quite honestly, today, if I took $250,000, I could buy a rental and I could net $900 a month. It rents for $1,800. 50% of it goes out in expenses. I'm netting $900 per month income on my $250,000 investment. But if I bought a note, I can average about $2,700 income on that same investment. So a note has a very good cash flow model that's different than rentals today. And once again, it just depends on which market you're in. I'm not saying notes have always been more profitable than rentals. I'm saying to you, this has happened before. And when it happened, because I've been around a long time, I could see it. Instantly, I could see it. Wow. You know, it's more profitable to be the bank today than it is the real estate owner, right? And people that have never been challenged into that, we can just simply whiteboard out some math, and we do in training, and we challenge it. Now, where do you live? And tell me about your property and how much you might like. We build out this math, and people are like, "Oh my gosh, he's actually right." And so it's just a matter of all of us in life. There's something happened to me yesterday that I had no idea. I'm 65 years old, right? I had no idea that this was a truth. And somebody pointed out some fact to me yesterday. And I'm like, you know what? I had never thought about that before. Well, that's life, right? We learn. So, hopefully, we're always learning all the time, right?
Yeah, absolutely. I'm saying this all along, and especially now that we have this AI stuff, it's actually insane how much new information. And then you go and say, can that be true? And it is actually turns in most cases it turns out to be true. Now, one thing again, a little bit targeted towards our audience, as you said, and you can say it's right or wrong, but our audience have, myself included, over times built a portfolio of rental assets. Now, there's obviously a little bit of a difference. When I look at mine, the average interest that I pay is like 5%. That's being mainly because I bought them much earlier. But the question I want to get to is, if somebody has a portfolio, let's say they have 10 properties or 20 properties or something like that, would you, if they came to you, say, tabula rasa, get rid of them, let's use the money, put them in notes, or are you recommending, okay, turn half of them, the least performing ones, over, or what would be your recommendation?
100%. Find the ones that don't make the best rentals. Listen, I've got clients with 500 properties. I'm not going to go tell them to sell all 500 properties, but there's 200 properties in there. This probably makes great economic sense. And we help them with modeling to identify which ones they are.
Okay, and then would you say in this, it sounds to me a little bit, if I'm trying to summarize what we discussed today, that it's a little bit like a sinus curve, right? Where you have times where the right part of the curve is to be in notes, and then there are times where it's more profitable, for lack of a different word, to be in the property. So it kind of has the wave or cycles or whatever word you want to use. For when we get just looking a little bit ahead, I'm assuming there might be a time again when that being the bank is not the best thing. Would that be then a time where people would buy properties back, or would you just say you keep a good, healthy mix and that's just your setup?
Well, I think no question that you have to be able to model it. Let me
Right.
ask you a question. What's the tallest building in most every town?
Church.
The church? I'd say the bank.
Well, those are bigger towns than I would say cities. Okay, good.
That's a good, okay. I mean the cities, right?
Yeah.
Go to any city and look at the tallest building in most every town. It's the bank. So there must
Right.
be something to the fact. Let me ask you a question. Where did most hard money lenders come from? They used to be a real estate investor, and they figured out they could make more money being the bank than they could the real estate investor.
Yeah,
Right?
absolutely. Right.
So this is what financial modeling allows you to do. It allows you to make a non-emotional decision, right? And I'm not telling there's 20 million houses owned by small landlords. I'm not trying to convert 20 million houses, okay?
Right.
But I'm saying to you that I deal with some fairly sophisticated people that own rental portfolios and manage tight, right? The math is just not in their favor, and their chief financial officer, sometimes that's a fractional guy that does it for several different investors, right? Their chief financial officer is looking at the math saying, hey guys, your rental property, it went up in value, but you're just not getting paid anything for the equity. You used to make an 8 cap on the same house, and now you're making a 4. And it's a truth. And they're going, this Eddie Speed guy is talking about converting your rentals and now being the bank, because you can make 2.5 times the interest income on being the bank that you can on your keeping the income and just doing it as a rental. And so which properties does that math work the best on? And then you model it out.
And that's
Right?
a perfect description. I think that is also, and should be for anybody listening to us, that should be the message. We're not saying do only this or do only that. We're basically saying analyze, hopefully with the help of an expert or mentor, like when it comes to notes with you, Eddie, take a look at your portfolio, find out which ones are the ones that are not that great in performance, and then basically get in touch with Eddie. What do you want to like describe real quick, like in 3 sentences, how that would look like when somebody actually starts contacting you and say, okay,
They do.
well, not just contacting, but they come into your program, they go into Note School or something like. Can you give like a short summary how that looks like?
Yeah. So the best way to do it is we have about a 2 hour or less masterclass
Okay.
where we ask people questions, we prompt people, and then we teach and we whiteboard so you can actually see the math. It's not hocus pocus at this point, right? You can see it. And then all of a sudden they can see two important things. First of all, a comparative of how you would analyze a rental. And then secondly, a comparative of if you took your next money and you bought a note versus you bought an investment property. And you could look at that and just say, okay, wow, I never thought about this. And we're going to show you leveraging strategies, right? Because people in their mind think, yeah, but I can leverage a house and I can't leverage a note. That is not correct. You absolutely can leverage a note. Listen, I didn't buy 50,000 notes with money sitting in my back pocket, right?
Right.
Right. And so we show people how to do they're not commonly understood techniques. That's why I built a school, because we're teaching people something that, there's myths about notes. Like people will tell me all the time, notes are complicated. And I'm like, no, owning a rent house is complicated. Owning a note is pretty dang passive. Right? You get a servicer and they just mail you a check every month. That seems like that's pretty easy. When you have a mortgage on that rent house you described to me, if the faucet's leaking, do you call the bank?
Oh yeah. I don't call anybody. The property
Exactly.
management takes care of it.
Exactly. But the point is you see what I'm saying? You now think about it. I've got a first mortgage on your house, and it's your problem to go deal with the tenant or the toilet or whatever, and I don't. So there's things about it that become a good diversification. Once again, I'm not saying that everybody dumps every rental they've got and just dive into this, but I'm saying to you, after you become aware of it and you then start learning some techniques of maybe how to model it, then you're like, oh my gosh, that's right. I hadn't even thought about another alternative. And I
Yeah.
think that's where we help people.
Yeah, absolutely. And it's so funny, right? Like I had literally made a little note right in front of me here saying diversification. You just mentioned it because that's really, I think, in all honesty, the thing, right? We all recommend and suggest to our investors that we are helping with and help to achieve their goals. Don't put all your eggs in one basket. But I think what we're saying today is your basket should include notes. And I'm really grateful for you coming on to the show and giving us a little bit of a glimpse. And I know this is a pretty math heavy thing. That's why you have the note school. For people to get in touch with you, Eddie, what would they need to do? Where do they go?
So I'm going to give them this master class. I think it's a great way to start. They're going to go to noteschool.com/ideal investor, right?
Okay.
And that we're going to know they're from you, right? So we'll have a sense of, like, we will probably suggest your audience is a little more sophisticated. They're not absolutely a newbie, right? So they have some, they're more investor oriented. They're not house flippers necessarily.
No, they're not at all.
And so that we know they're our tribe. We feel like we can help your people a good bit. And so we're going to have this little master class, and just go to the page. You're going to register. And then all of a sudden, you are then going to be able to spend some time with us and ask us questions, not just us be a talking head.
Yeah, I absolutely believe it. And you're a very convincing guest on the show. So thanks again, Eddie, for being here. And I will definitely take you up on it. I will talk to our existing client community. We call it the tribe, and see who wants to come join me with it. But everybody out there, I really want to encourage you, because you cannot ever know too much. So even if you end up deciding, okay, it's not for me, not right now or whatever, gaining the knowledge through what Eddie has just offered us is really, really something that I think everybody should get. So again, thank you, Eddie, for doing that. One last question, completely unrelated. If you could meet anybody, dead or alive, who would it be and why?
Warren Buffett. I just think he's wise. I think
Well, I think that's a given, right?
yeah, and I just think that he has been a steady hand in the market, and he doesn't he has a focus that allows him to stay focused on what things are telling him and not listen to noise. And so I'd want to ask him a sequence of questions about what disciplines he's developed so he's able to do that.
Cool. Can I have a follow-up question? Would you ask him if this unbelievable mountain of cash that everybody says he has in cash, if he really has that in cash? Do you believe that?
I think he probably does. I think he's not as optimistic on the market as some people are. And I think he is sitting on some dry powder because I think he's going to be opportunistic when it comes along. That's just a dart throw, but I sure would ask him.
Yeah, I would ask him too if I had the chance. I think it is equivalent to cash, but I don't think it's really cash as like you and I have in our wallet or something like that. I think he has probably some bonds and maybe some notes or things like that. Short term, obviously, so it's liquid, but
I agree with that. He's invested that cash in something that turns into cash quickly.
Yeah, and at least to maintain above inflation slightly, so. And it's not hard. I mean, you can get treasuries left and right for better than inflation right now, so. No. Okay, wonderful. So guys and girls out there, noteschool.com is where you need to go to get in touch with Eddie, and then add an investor show so that you get the masterclass and they know that you come from our show. So Eddie, thank you so much for spending the time to be such perfectly prepared and concise. That's really much appreciated.
Awesome. Thank you.